And while everyone's focusing on the Fed, maybe some people missed the data that had German GDP contracting again. The German economy has been going nowhere for basically a year. Other data in the US, of course, as well as the Fed, is definitely going to cut rates in September, I would say. But keep an eye on those oil prices. I mean, all the pieces are set on the table. The Fed is going to cut probably twice this year, unless the oil price runs up and the geopolitical tensions in the Middle East won't be helping that outlook. So do be careful. The risk scenario is that we don't actually get a Fed cut because the oil price takes off. But I think we'll get at least one. But I think 2 Fed cuts depends on what the price of oil does. Chicago PMI, 45 something. Deep contraction. I mean, manufacturing across the United States has pretty much been in contraction for 2 years now. It is a manufacturing depression that no one wants to talk about because everyone wants to say the US economy is strong, which of course we all know isn't. And then in Australia today, we had some manufacturing data as well, the Judo Bank manufacturing PMI, and that was 47.4, edging slightly higher from 47.2, but still deep contraction. In fact, deep COVID contraction levels for Australian manufacturing, and services are slowing in Australia as well. We are definitely heading into a recession in Australia. What does all of this mean for markets? Well, I suggest you keep an eye on the US Treasuries market because it's had a very strong rally. Remember, I was bearish when everyone was bullish, and we did very well on that, as in expecting higher yields price to fall. Now we've had a very good price rally. Yields have dropped, and the price still looks very strong on the idea of the Fed will be cutting rates, so buy the long end. Now, the problem with that, of course, is that in America, the people who predominantly trade this market, they don't get that the rest of the world's a little bit not totally happy about the fiscal crisis the United States continues to accelerate deeper and deeper into. Therefore, that's why in the long run, the United States has to pay more to borrow money because it's a juggernaut with no respite in sight. Now, what I see as a possible scenario of how markets will work through this mix is that a last gasp rally in the US Treasury market going into the first Fed rate cut, at the latest the second Fed rate cut, but possibly the first Fed rate cut, will open the eyes of BRICS nations that want to reduce or exit the US Treasury bond market because they've seen how willing the US is to seize assets when there is an international disagreement, and therefore they don't want to hold their money there anymore. And that's why China's been selling and other people have been selling as well. Now, what I think is going to happen is that the BRICS countries, and there's 23 of them now, are going to reduce or exit the US Treasury market once the Fed starts cutting rates, because they'll be thinking that's the best price we're going to get for our 10-year US Treasuries, which is the market I'm mostly watching. So when the US Treasuries start to fall in on themselves after the Fed rate cut, that's when the stock market gets very, very wobbly indeed. For the moment, the market wants to rally into a Fed decision and rally the day after or for 2 days. But I'm not a big believer in this bounce in the US stock market. I think we're going to have increased volatility, so it doesn't matter that it was a big up day because we can have big down days as well. So yes, the upward pressure at the moment in price action for US markets, US stocks, is to the upside on a sort of next few days basis, maybe ending even as soon as within 24 hours. I think the overall risk to the US economy is very much to the downside. And I do think the US Treasury market at some point is going to be seized upon as an opportunity to sell. And then what will result is much higher yields regardless of what the Federal Reserve does. And I've been saying that all year long. It doesn't matter what the Federal Reserve does. US long end yields are going higher, still going higher in a big picture sense, not on a month-by-month basis perhaps, or a week-by-week basis, but in a big picture sense, US Treasury yields are going higher, and that is another dampener upon still firm price gains that are hurting consumers and businesses, slowing economy, manufacturing in deep depression, home sales plummeting. it's not a good outlook for the US economy. It doesn't matter who becomes president. The United States has troubled waters ahead. I hope this helps. Have a great day. I'm trying to cheer you up with the opportunities that all of this brings. All right, thank you very much.